Bismillahirrahmanirrahim. Assalamu alaikum everyone. My name is Yasir Yamin and I welcome you all in this session. Guys, in today's session, we'll be discussing one more past paper, which is again from March, June 2023. And the name of the past paper is Eloa. Eloa. Now, from my belief, this is a very good and easy past paper to attempt. Nothing of this sort you can say this is very technical past paper, but at least one area in this whole question is what I expect to be repeatedly tested in SBR exam from now on, and that one area we need to surely focus on. It is going to come towards the end, but we need to prepare ourselves for that particular part because it's becoming a routine in each and every attempt that that portion is tested, right? We will talk about it later, right? Let's read the background information first, as we always do. So background information says Eloa company is the parent company of a group and a multinational sports clothing manufacturer. So you are a parent company of a group and you basically are a multinational corporation so that you have, you know, you have your establishments available overseas as well. And you are a manufacturer of sports clothing. So a company like Nike or Adidas. The company is preparing its group financial statements for the year ended 31st December 2007. You always need to mark down what is your accounting year end. 31st December 2007 is your accounting year end. That means it starts on 1st January X7. It says the following exhibits provide information which is relevant to the question. There are 3 exhibits in total. But before you open these exhibits, just read the background information first, right? So the first exhibit is going to be about operating segments. This will outline information about various divisional activities of the company for the year ended 31st December 2007. Now, I ask you, you are sitting in your examination and you read the topic or the heading of the first exhibit, and that is operating segments. What comes into your mind, guys? Which accounting standard comes into your minds when you see the words operating segments? Which accounting standard, guys? At least you should remember the name always. So it's all about IFRS 8. Bilkul correct. IFRS 8. IFRS 8 is about operating segments. Now, according to IFRS 8, operating segments are basically components of an entity. But not every component of an entity is supposed to be an operating segment. You cannot call your finance department an operating segment. You cannot call your HR or legal department as an operating segment. There are 3 characteristics which, if you find in a component of an entity, you will call that component as an operating segment. It's a segment that operate on its own, right? Now, there are 3 characteristics of an operating segment which have been defined under IFRS 8. What are those 3? Does anybody remember? An operating segment is a component of an entity which engages in business activities and earns revenue and incur expenses. Do you guys remember? Any portion of an entity, not any portion of an entity, but any portion of an entity that engages in business activities, right? Earns incomes and incur expenses. Number 2 condition, whose operating performance is regularly reviewed by CODM, Chief Operating Decision Maker. Now, Chief Operating Decision Maker, in sometimes Chief Operating Decision Maker is the CEO, or that person is the COO. IFRS 8 clarifies that Chief Operating Decision Maker is not a title, it's a function. Now, that function could be held by a managing director, a CEO, a CO, whatever name you call it by. But a Chief Operating Decision Maker is a person of authority who regularly reviews that component's performance. And for that component, discrete financial information is available. That is the third condition. Now, if these 3 conditions are met, then that component of an entity will be classified as an operating segment. I'll ask you a question. I'll ask you a question with reference to IFRS 8. Under IFRS 8, do we need to report all operating segments under the disclosure? Do we need to report all operating segments under a disclosure? No. The answer is no. Under IFRS 8, it's not necessary to report each and every department or function or component of your entity in a disclosure, because then in some cases the disclosure might be so lengthy that it won't provide the value for money. For example, Unilever might have might have 50 odd brand names or brand products, and each brand might be a component of an entity in itself, right? Unilever has many brands and which operates under their umbrella. So it's almost impossible to create a disclosure with 50 operating segments. So IFRS 8 says that we have provided you a quantitative threshold, and if any of the quantitative threshold is met by any component of your entity, any operating segment of your entity, then that particular operating segment must be disclosed under a separate disclosure of operating segments. Now, does anybody remember what were those three thresholds, quantitative thresholds? And remember, any one of them should be met in order to become a reportable segment. Does anybody remember? So I'll tell you the percentage. You should recall those criterias with the quantum of 10%. 10% was common in any of those three criteria. It was common under those three criteria. 10%. You don't remember now? Don't worry. An operating segment of an entity, if its revenue, both internal and external, is 10% or more of the combined revenue of the entire entity, then it's a reportable segment. Or if the profit of that operating segment is 10% or more of the combined profit of all operating segments that did not report a loss, or is 10% or more of the combined loss of all operating segments that did not report a profit, then that operating segment is also a reportable segment. Or if that operating segment's assets are 10% or more of the combined assets of the entity. Now, this is a 10% series threshold. If any of these quantitative threshold is met, then you must provide that operating segment as a reportable segment. That is, you should be providing it against a disclosure. Does everybody recall it? I'm presuming that most of the students in our session do not recall what IFRS 8 was. Is that correct? And even if that's correct, let's assume that's correct. Even if that is correct, you had the opportunity to revise it with me. Make sense? But now do you recall it? At least you should. So I was saying that the first exhibit is going to be about operating segments. The next segment is going to be about performance. This exhibit is going to set out the performance of the divisions for the year ended 31st December 2007. So some performance analysis might also be included. The third exhibit is going to be about investments that we have made in Genic company, describes the relationship with two partners in setting up the manufacturing entity. So technically we have made an investment in Genic company, but that investment was made in partnership with two other people, or maybe two other entities. Can anybody give me any idea that if you are investing in Genic company by partnering with other people or other corporations, what mode or which IFRS you might be exposed to in such a scenario? You are partnering with someone to invest in a particular entity. Which IFRS might be exposed here? Think about it. It's common sense. I want you to get ready for the exam, because in an exam, something should trigger in your mind while you're reading the background of these exhibits. Very good. Joint arrangement. If you are partnering with someone to collectively invest in something, most likely it's a plausible case that examiner is talking about joint arrangements. And in particular, somebody told me, Abhishek pointed out, sir, in joint arrangements, it might be a joint venture because us as Eloa company and two other partners are collectively investing in a separate legal entity, which is Genic company. This might be a joint venture scenario. Absolutely correct, right? So I want this level of mindset of you when you are entering into your exam. The introduction of exhibits should talk to you. You're not going to wait for your examiner to tell you everything. You should have your brain, which tells you what could be the real scenario here. All right. Now, before even moving towards the exhibit, I always ask people to look at the structure of the requirement first. So now here you can see that the whole question has been divided into three parts, A, B, and C. And in total, you can see this is 25 marks, right? For now, we are just going to focus on the first requirement, which is requirement number A. And in total, part one, part two, in total, it is of 9 marks. So it might be, very simple for me to assume that each of these parts, part one and part two, carry equal weightage. Let's say 4.5, 4.5, or 5 or a 4, right? It would be most wise to assume like that. So I need to give equal weightage to each of the parts. Make sense? A part one. It says that using exhibit one only. Please mark this out. While you are solving for A part 1, you are not going to see exhibit number 2. They say using exhibit 1 only, discuss in accordance with IFRS 8 operating segments whether the 4 divisions owned by Eloa company should be classified as an operating segment. How do you classify something as an operating segment? Can anybody tell me how do you classify something as an operating segment? We just discussed it right now. An operating segment is supposed to be a component of your entity, right? Engages in business activities and earns income and incur expenses. Number two, chief operating decision maker reviews its performance. Its discrete financial information is available, right? Now, these are the primary three criterias that help you to assess that whether a particular component of an entity could be classified as an operating segment or not. Remember, guys, the thresholds that I just discussed with you, 10% thresholds, those thresholds only help you in assessing whether these operating segments should be reported or not. But in the first case, you need to identify if a particular component of an entity can be termed as an operating segment or not. That's your first job. All right. So in exhibit number 1, we are only required to assess or discuss whether something, the 4 divisions owned by Eloa company, should be classified as operating segments or not. That is, we need to assess if these three characteristics are met or not. This is our job only. Right. I'll need your help. Okay. Let's go to exhibit number 1. Examiner says, Eloa company's equity instruments are listed. So there are there are external investors involved. Remember, whenever there are external investors involved, you might want to provide more clear, crisp, and detailed information to external parties so that they can decide how much to allocate their resources onto our business and they can make their investment decisions carefully. If it was a private limited company, investors are friends and family members. So the disclosure requirements or the transparency requirement is less. But when you are a listed company, more information is to be provided to external investors or potential investors so that they can decide how much resources they want to allocate to our business, right? So Eloa company's equity instruments are listed. In the year ended 31st December 20x7, it operated 4 divisions. tennis gear, badminton, squash racket, and casual wear. All right, so there are four divisions, guys. And I think it would be very much hard to remember all of these by their full names. So we can call them like tennis gear, TG. It could be badminton wear, it could be BW, right? And then there could be squash racket, SR, and casual wear, CW, right? So these are short forms of the four divisions that we have. It says casual wear, this one. Casual wear operates overseas and produces sports clothing. It sells 90% of its production to the other three divisions of Eloa company. So primarily, first of all, casual wear is overseas. They told us that it's a multinational company. Then their job is to manufacture sports clothing. And what they do is they sell their sports clothing internally to other business segments, which includes tennis gear, badminton wear, squash racket. So, three different games, three different market segments, three different type of customers are targeted through different divisions. All right. Badminton wear and squash racket sell the same clothing with different brand names. Very good. Badminton wear and squash racket have same products. Can I say something? Can I say something? मामू बना रहे हैं यार. मामू बना रहे हैं. Same product. They have same product and they are selling the same product under two brand names. So they could target squash playing people separately and tennis playing people like Nadal, Roger Federer separately. But these are the same clothes. To squash people, they tell, we prepare this specially for you. For tennis people, they tell, we prepare these type of clothing specially for you. Internally, that's not the case. Okay. So technically speaking, badminton wear and squash racket sell the same things, right? So it was not tennis, by the way, badminton and squash. I humbled it out. Then they say Eloa company has stated that making the specific disclosure required by IFRS 8 operating segments might affect its competitive position and be misleading. The directors of the company or Eloa company, they are saying that please do not assess if these four divisions are operating segments or not. We ask them why. They are saying we do not want you to assess if these are operating segments or not, because either way we do not want to make any disclosure. We ask them, why do you not want to make disclosures about the divisions that you are operating? They are saying that it might affect our competitive position and might be misleading. Therefore, the company has currently elected not to disclose any segment information. My first question: can a company choose whether or not to provide disclosure of operating segments under IFRS 8? Is there a choice, or that particular ICE or IFRS must be mandatorily followed? I'm asking you this question. Is there a choice? No. All right. Is there any exemption for companies who say that we do not want to provide an operating segment because it might give us competitive harm? Because our competitors would then know that what type of our products have what type of margins, and how much we do business for badminton wear, how much we do business for squash rackets, and so on and so forth. So they are saying, since the information would get disclosed to our competitors, therefore we say that no disclosure should be provided. Is there any such exemption available under IFRS 8? If the company expects that there would be competitive harm, provide no disclosure. The answer is no. You see, under conceptual framework, the whole idea is to provide investors and potential investors the information so that they can make their decisions in a better manner. Now, during that course, it is possible that the entity might feel that their performance or their competition might get to know something which normally they wouldn't get to know. But, you know, even if there is a risk of your competitors knowing something about your company, does not preclude that your investors do not have the right to know how the business is being run, right? So, as far as Eloa company's statement is concerned, it is entirely incorrect. They have no mandate to say that they are not going to follow IFRS 8. They have no mandate or choice to say that they are not going to provide operating segment disclosure just because they feel that if the information is made public, they would, it might create competitive harm. That does not make any difference, right? But what makes a difference? You see, these four divisions will be called as an operating segments if three conditions. I'm repeating those again. IFRS 8 will be easy for you after this class. Three conditions. Business activities are in progress, CODM reviews your performance, and financial information is available. As far as that is okay, operating segments will be called components of an entity. These four divisions will be called as operating segments. They are saying the company's chief executive officer, who is the CEO, is the chief operating decision maker. Each division has a manager who reports directly to the CEO. So, what they are saying is there are four divisions. So, technically speaking, there are four business managers, divisional managers, but all of these divisional managers directly report to the CEO, right? Examiner is saying, and their compensation is partly based upon the division's results. Every quarter of the year, the CEO reviews the statement of profit or loss and key performance measures, such as EBITDA for each division. The division managers meet the CEO each quarter to review the division's performance and compare the actual results to budgeted figures. So they are used to comparing the division's performance. They are very well versed in comparing your actual results to the budgeted figures. If the CEO regularly or quarterly reviews your actual results against your budgeted results, then that means that for each division, discrete financial information is available, right? If discrete financial information about each of these four divisions was not available, how would the CEO review your performance? How would the CEO compare your actual performance with the budgeted performance if there was no discrete financial information available? Definitely, discrete financial information is available. Examiner says the final budgets for each divisions are based upon performance and are approved by the CEO. So don't you think discrete financial information is available? Their performance is regularly reviewed by the CEO, who is the chief operating decision maker. So CODM is also met. All of these four divisions engage in business activities, earn revenue either internally or externally, but they earn revenue and incur expenses. So don't you think all of these four divisions meet the criteria under IFRS 8? What do you guys say? Make sense? So the requirement of examiner was that we had to discuss in accordance with IFRS 8 whether four divisions owned by a lower company should be classified as operating segments. Our answer would be yes. I've drafted an answer for you. I'll just show it. I'll just show you a very good glimpse of this answer. First of all, I talked about IFRS 8, right? And mentioned the conditions as they were under IFRS 8. Then I did talk about the statement that was made by Eloa. The statement made by Eloa not to provide a disclosure because it may lead to competitive harm does not conform to the objectives which were laid down by International Accounting Standards Board. Eloa company should rather provide for an appropriate disclosure whilst avoiding any misleading presentation. Then, in the second paragraph, I did discuss this fact that in this case, there seems to be four operating segments. All of these divisions engage in business activities, earn revenue and incur expenses. Furthermore, the CEO, the CODM, reviews their performance regularly on each quarter and use key financial information available like EBITDA to appraise their performance. Hence, discrete financial information is also available. Obviously, as I started the question, I detailed down the other requirements of IFRS 8 as well. This was part of introduction. But overall, do you understand how you need to discuss? Most part of this requirement would be spent in just defining what IFRS 8 says. If you read this whole paragraph, I've just replicated the understandings of IFRS 8 again. So I always say that if you have learned the accounting standards by heart and you have a very good understanding of each and every accounting standard, there is a very good likelihood that at least 50 or 60% of the paper you'll be able to complete just by the way of rote learning of those IFRS. Yes, the other 40-50% you might not be able to do until unless you have very good understanding and you apply that knowledge within the context of the scenario. But at least 40 to 50% of the paper can only be done just by having rote knowledge of IFRS. Make sense? Make sense, guys? So I would want you to read the answer once you have the question paper in front of you and you have the Eloa question in front of you. But please make sure that do read the answer. Do identify that, could, you need to make an assessment if you could write such an answer or not. All right. Just make sure that you go through this answer for sure. Right. So now we are done with part A, part one. And now we are going to move towards the more interesting part here, which is part number two. Now, examiner says using exhibit 1 and 2, determine in accordance with IFRS 8 whether the four divisions owned by Eloa company should be identified as separate reportable segments, whether these four divisions can be termed as reportable segments or not. And remember, whenever we talk about reportable segments, the quantitative thresholds come into play. Remember those quantitative thresholds that we just discussed? 10% of revenue, 10% of profit or loss, 10% of assets. These were the criterions. Make sense? All right, understood? And the second point is whether it is necessary or possible for any of the divisions to be combined into a reportable segment for Eloa company. Now, this is a calculative part. Just let's go to exhibit number 2. I'll explain it to you. Now, in under exhibit number 2, you have been provided with divisional performance of 4 divisions, right? You have been provided with their external revenue, internal revenue, profits, assets. And once you total all of this information, you have total external revenue, total internal revenue, profits, and assets. Now we need to assess which division will be a reportable segment and which division will not be a reportable segment. And for this, in order to assess this, we need to go through our quantitative thresholds, right? Quantitative threshold number 1, 10% of total revenue, right? Guys, in our case, the total revenue, which is the external and internal both revenue combined, the total revenue that we have is 20.6 plus 10.8, right? If we calculate 10% of this revenue, can anybody tell me what is the 10% of this revenue? What is the 10% of this revenue? 20.6 plus 10.8 multiplied by 10%. If anybody could tell. Okay, this is 3.14. What does this 3.14 million suggest? If any of the division has revenue of 3.14 million or above, it will be termed as a reportable segment. If you're still unable to identify a reportable segment based on revenue, then the second criteria is that that particular component of an entity meets the criteria of 10% of profit or loss, right? Now, if you see, all of these divisions are in profit. None of the divisions are under loss, right? And if you cumulate the total profit of the combined entity, it is 6.4 million. So 6.4 million into 10% is 0.64 million. So for any of the division, despite the fact that even if revenue is not met, and if any of the division has profit or has profit of 0.64 million or more, that will be termed as a reportable segment. Understood? Understood? The third point is 10% of assets. Now, total assets I have of 42 million. If I calculate 10% of this will be 4.2 million. Any division that if does not meet the criteria of revenue or profit or loss, then if it has assets of 10% or more, then it will still be a reportable segment under IFRS 8. All right. Now we need to judge each of the divisions against these thresholds, these 10% thresholds, right? Let's go with tennis gear first. Does tennis gear, and I can rather do it like this. We have 4 divisions, right? Tennis gear, badminton, tennis gear, BW, SR, and CW, right? Casual wear, right? Now we have 3 thresholds: revenue, profit, and the third one is assets, right? Let's focus on TG first, tennis gear first, right? Our threshold is for revenue, by the way, our threshold is 3.14. For profit, it was 0.64. And for assets, it was 4.2, right? As far as tennis gear is concerned, do you think that its revenue is 10% or more of the combined revenue of the entire entity? Or in simple terms, do you feel that tennis gear's revenue is 3.14 million or higher? Yes or no? Give me a yes or a no. Give me Y or an N. Yes. So as far as revenue condition is concerned, tennis gear already meets the criteria, quantitative threshold criteria of IFRS 8. We can even check on, on the basis of profit and assets. The requirement for profit was only 0.64 million. Tennis gear has a profit of 2 million. The requirement for assets was only 4.2 million. Tennis gear has assets of 15 million. So can I say tennis gear meets the criterion from all aspects? Though, even if one requirement was met, it was supposed to be a reportable segment in any case, but at least, in the case of tennis gear, all of the requirements have been met. Make sense? Done? Let's talk about BW, badminton wear. Do they have revenue of 3.14 or more? Do they have revenue of 3.14 or more? No. Do they have profits of 0.64 or more? No. Do they have assets of 4.2 or more? The answer is no. For the purpose of badminton wear, can we say that none of the criteria to qualify as a reportable segment has been met? Is everybody clear on this? I would want some response from you guys. Are you guys clear on this? Make sense? Let's go for squash racket. For squash racket, do they have revenue of 3.14 or more? The answer is no. Do they have assets? Also, do they have profit of 0.64 or more? The answer is no. Do they have assets of 4.2 million or more? No. So technically speaking, none of the criteria for squash racket is also met. Do you all agree? Can I say, please listen to me very carefully. Can I say that BW, and SR are not reportable segments? Please respond. Can I conclude this? TG up till now is a reportable segment, whereas BW and SR are not reportable segments. Do you all agree? Do you all agree? I want an answer from everybody, guys. Indeed. But at the same time, I would like to point out a separate condition under IFRS 8. And for this, examiner already gave you a hint. Let me take you towards the requirement, guys. Examiner said whether it is necessary or possible for any of the divisions to be combined into a separate reportable segment for Eloa company. Do you remember IFRS 8 clearly? Under IFRS 8, there was something which was known as an aggregation criteria. This aggregation criteria called for the fact that if two or more segments were in the same line of business and have the same business risk, they could have been combined. They could have been combined to assess if, on the basis of combination, they are reportable segment or not. Do you remember that? Under IFRS 8 allowed you to combine two or more operating segments and treat them as one, and then check if the reportable segment requirement is met or not. And this combination, this aggregation can only be done. This aggregation can only be done when both businesses are in the same line of business, when the business risk is same, right? Let me recall something to you. If you read the question clearly, examiner told us clearly that BW and SR deal in the same products. BW and SR deal in the same products, just the names are different. The business risk is same under both areas. Don't you think we can aggregate these two divisions? I think we should. We should be aggregating these two divisions, especially in the light of examiner mentioning you this in its requirement. You should be aggregating these two divisions, guys. You should be aggregating these two divisions. And if we aggregate these two divisions to treat as one, that means the revenue of these two would be 1.8 plus 1.6 would be 3.4. Their combined profit would be 0.8. Their combined assets would be 7 million. Do you think once these two divisions are aggregated, they would meet the thresholds that were set by IFRS 8? Do you think? Give me an answer, yes or no? Yes. So technically speaking, our answer, which was up till now that it's not a reportable segment, would change once the aggregation criteria is applied. Once the aggregation criteria is applied, revenue, profit, and assets, although I'm repeating it again and again, even if any one of the condition was met, that was more than enough. But in this case, all conditions are being met. Definitely, this is a reportable segment. Definitely, this is a reportable segment. Done. Last but not the least, only one thing is remaining, which is casual wear. We talk about casual wear. Their combined revenue, their external internal revenue combined is around 12 million. Our threshold was only 3.14 million. Revenue condition is met. For profit, it had to had a profit of 0.64 million. They have 3.6 million. For assets, the requirement, the threshold was 4.2 million. They have $20 million worth of assets. So definitely for CW even, all of the criteria are met, and hence it is also a reportable segment. So if I ask you guys, how many reportable segments will be there? How many? How many reportable segments would be there? Very good. Very good. Excellent, guys. Perfect. Done. So again, as per practice, I have written an answer for you, which is available to you. But nothing here you would see that is nothing here you would see that we haven't discussed it, right? So I've already solved this with you guys separately, but still I'll provide you an answer so that you learn how to write an answer. The learning approach, the wordings should be carefully assessed. Inshallah ta'ala, this will help you a lot. All right. So without wasting any time on reading the answer which is written by me just for the purpose of helping you, I would like to take you directly towards this B requirement, right? B requirement is of 7 marks. An examiner says discuss how the investments in Genic company should be accounted for in the consolidated financial statements of Eloa Group and discuss whether Genic company can be classified as an operating segment. Now there are two questions. The first question is how the investment in Genic company should be treated. The second question is whether that investment can be shown as an operating segment or not within the consolidated financial statements. So there are two questions. All right. So let's read it out. Exhibit number 3, investment in Genic. Just give me a moment, please. Continue. So investment in Genic. It says that on 1st January 20x7. On 1st January 20x7, Eloa company has undertaken a venture with two other venturers. On 1st January x7, Eloa company has undertaken a venture with two other venturers and called the entity Genic company. What's happening? So we are Eloa company. We have two other partners, partner 1 and partner 2. We all three combined together to start Genic company as a venture. Let me ask you, is this arrangement a joint arrangement? Is this arrangement a joint arrangement? I'm asking you a question. Is this arrangement a joint arrangement? Three people or three entities are combining together to do business together. Is this a joint arrangement exposed under IFRS 11? The answer is no. You cannot tell yet. Under IFRS 11, a joint arrangement was supposed to be an arrangement between parties, and there was supposed to be a contractual agreement between parties, which provides that relevant decisions of the entity will be done through unanimous consent. I always told you that in order to identify a joint arrangement, you should always seek if there is a contractual agreement between the parties or not. Now, up till now, we haven't seen any contractual agreement between the parties. So it would be too soon to conclude if it's a joint arrangement or not. That's what I'm trying to say, right? Let's go back. It says that Genic company will manufacture tennis and badminton rackets and will supply rackets to tennis gear and badminton wear. They are saying each venturer owns equity with 1/3 of the voting rights. Each party have 1/3 of the voting rights. 1/3, 1/3, 1/3, or 33.33%, 33 point, let's say 34%, and 33.33%. Make sense? Examiner says each venturer owns equity with 1/3 of the voting interest, which also carry rights to net assets. Rights to net assets. It's a joint venture for sure. If it's a joint arrangement, it's a joint venture for sure because you have a right to net assets, right? Net assets of Genic company. All key decisions which affect the venturer are made by a unanimous vote of the shareholders as outlined in an agreement between the ventures. Now I ask you the same question again. Is this a joint arrangement? Yes or no? How do you identify that? There must be a contractual agreement between the parties. Do you see a contractual agreement between the parties? The answer is yes. Point two, does it require unanimous consent? Point two, does it require unanimous consent? The answer is yes. If both of these conditions are met, then it is a joint arrangement. And under joint arrangement, it will be more specifically a joint venture. Do you all agree? Is it clear to everyone? If it's clear, then here comes the potato. It says, however, Eloa company has the option to purchase an additional 5% of Genic company's equity shares from each of the other two venturers for a fixed price at any time. What is this? Guys, they are saying that Eloa company has potential voting rights. If they exercise their rights, then they have the capacity to acquire 10 further shares, 10% further shareholding in the entity. They can take 5% from P1 and 5% from P2, and hence they could go from 33.33% to 43.33%, an increase of plus 10%, right? So they will become the major shareholders. Is this still a joint arrangement or is it really an acquisition? Because Eloa company has the majority shareholding. Do you feel if this is an acquisition, this is an IFRS 3 topic, or if it's still a joint arrangement topic? What do you guys think? What do you guys say? Is this a joint arrangement or an acquisition? At least one person says, sir, it's still a joint arrangement. Why do you say so? We have 43.33%. The other people have quite less than us. Why is it still a joint arrangement? Because guys, even if you have 43.33% and the other parties have less percent holding, still it requires a unanimous consent. And the other two parties can always join up to overturn your decision. No, Abhishek, your justification is wrong. You are saying that it's not an acquisition topic because accounting boundary is not crossed. You are saying Eloa company is not the parent company in this scenario because you have not 50, you have not more than 50% shareholding. But under IFRS 10, 50% is no more the criterion. You can be an acquirer even if you have 43.33% shares, right? But in this case, those 43.33% shares do not help you. Why? Because there is an agreement between the parties which requires unanimous consent. So in order to direct the relevant activities of the business, you always have to go to other people to seek their consent. And then only the business can be run. There is no other option. And when you go to the other parties, cumulatively, they have more shareholding than you, right? Cumulatively, if you have 43.33%, they have like 56.67%. Make sense? So what I'm trying to mention here is the concept is not accounting boundary is crossed or not. You can be an acquirer even with 40% shareholding. That's not the topic. The topic is there is a agreement between the parties which requires unanimous consent. There are two other parties who can, if they collude together, they can overturn the decisions of a lower company. There is no control. There is a joint arrangement. Clear? Is it clear to everybody? Is it clear to everybody? I want an answer from everyone, guys. Very good, guys. Excellent. Your examiner also asked you if this investment in Genic company can be termed as an operating segment or not. So anything, any component of an entity, you see, you on a group level, even if you have joint control over some operations, that does not matter. But if you have component of an entity which engages in business activities, earns income and incur expenses, their performance is regularly reviewed by CODM and discrete financial information is available, any component of an entity can be classified as an operating segment. So the second point that examiner asked me was to discuss whether Genic company could be classified as an operating segment. Let's see. Genic company's financial results are scrutinized quarterly by the CEO of Eloa company and other ventures. Eloa company CEO reviews the result to help make decisions about the allocation of future resources and to determine whether to continue with the venture or not. Number one, does Genic company, on which we have only joint control, agreed. But does Genic company, the investment in Genic company, does it engage in business activities? Yes. You know, does the CODM review its performance, regularly review its performance? Yes. Is there discrete financial information available? Yes. So can Genic company be classified as an operating segment, even if that operation, that Genic company operation is not your wholly owned baby? You only have investment in that particular business. But still, even if you do not have 100% holding of that particular business or that particular part, can that part still be disclosed as an operating segment because it is being managed as an operating segment? Can that be done? The answer is yes. Understood? So let's see how I have written the answer. Whatever we discussed, I have written that in the answer. Let's go towards it. Right? So I won't read this part, right? This is all IFRS 11 as it is, but the explanation part. In this case, Eloa company has a call option to purchase 10% additional interest in Genic company, thereby becoming the major shareholder. However, the agreement between the parties still stipulates that unanimous consent is required to run the business. Therefore, this will be a joint arrangement. A joint arrangement may be accounted for as a joint operation or a joint venture. If a separate entity is formed, then this is generally termed as a joint venture, whereby each party to the arrangement has significant influence over net assets of the newly formed entity. Such a joint venture is accounted for under equity method. As far as IFRS 8 is concerned, guys, the explanation part, in this case, the investment in Genic company meets all of the criteria under IFRS 8. A joint venture should be considered for an operating segment disclosure, even if the company has joint control. Its performance must be regularly reviewed by CODM of our company in order to make relevant decisions and for allocating resources. Do you all understand that what was supposed to be done in the case of Genic company? As far as accounting for organic company is concerned, IFRS 11 was applicable. And as far as the examiner's second part was concerned, if this could be classified as an operating segment or not, the answer was yes. Is it clear to everyone? Believe you me, if I feel that if anyone wants to practically apply IFRS 8 or they want to revise IFRS 8 in totality, this is the right question. Just revise this question before your exam and you are done with IFRS 8 altogether from variety of contexts, right? It's a very good question, I would say. Then there is a last part given in your exam, which technically is a homework because you have to read it yourself. But believe you me, sometimes I tell something to my students and it literally works out. But believe you me, this is one of the most important areas that you could prepare for your exam. The area says that you need to explain why segmental information, why operating segment information is important to investors. Obviously, it's important for investors so that they can make their relevant decisions. But you need to explain this in the within the context of 7 marks. This is investor's perspective. Remember, in your every paper, there will be at least 7 to 10 marks for investor's perspective. And you do not need to do anything extra. You just need to think about the accounting standard, think about the investor, and why your investor would like a particular, a particular sort of information on something. Just consider why your investor would want a particular type of information, or how your investor would benefit when he sees the information which is required by the framework or any of the accounting standards. You just think about it. That will be the answer. I'm just giving you a homework. You need to make sure that you read this particular part. you know I just copy pasted whatever was there in your examination kit. I think it's perfectly written. It's lengthy. For 7 marks it's too lengthy, but still I believe that it will help you understand how to answer investor perspective parts. All right, so please do read this out. Do not miss this question. And telling you, you'll regret it if you're not doing Eloa company, or at least this C part as part of your preparation. If you're not doing this, you will regret it after your exam. I'm telling you that. Please do it. Make sense? So is it clear to everyone? Is it clear to everyone?